I've been selling real estate here in Southern California for 33 years, and I'm about to say something that may sound completely backwards to what you've been hearing in the news. Mortgage rates are finally starting to come down, but historically, when rates fall, homes often become more expensive, not less. And if history repeats itself, buyers who sit on the sidelines waiting for rates to drop further may once again find themselves priced out of the market. Today I want to explain why that happens, what we're already starting to see here in the Valley, and what buyers and sellers should be watching instead of interest rates. You've probably been thinking about buying a home, and you've probably noticed something over the past several months. Mortgage rates, which had climbed into the 8s and 9s, have begun drifting back down into the 5 range. And naturally, it just feels like good news. Lower rates mean lower payments, and lower payments usually mean more affordability. But here's what many buyers just don't realize. Interest rates don't operate in a vacuum. They influence buyer behavior, and when buyer behavior changes, so does the real estate market. Already we're starting to see more activity, more open house traffic, more showings being scheduled, more buyers stepping back into the conversation. And historically, that's where things begin to shift. For the past 3 decades, I've watched real estate market move through multiple cycles, and one pattern has been remarkably consistent. Roughly every 8 to 10 years, the market heats up, buyers eventually reach affordability limits, and then prices adjust to bring buyers back into the market. And that's what I would call an organic real estate cycle. But if we zoom out and look at the national home value trends going all the way back to the 70s, even with all the peaks and valleys, historically, values have appreciated about 3.5% per year. Here in California, that number is closer to 7 annually. Now, that kind of steady growth is actually healthy. It allows homeowners to build wealth gradually and sustainably. Most importantly, predictably. But sometimes outside forces accelerate that cycle. And that's where we are today. Following the Great Recession in 2008, the Federal Reserve began purchasing mortgage-backed securities to inject liquidity into the housing market. In simple terms, that helped push mortgage rates lower, which encouraged buyers to re-enter the market. And we saw something similar during the pandemic years when rates dropped and buyer demand exploded. Home prices didn't just rise, they skyrocketed. But when that support was removed, the market corrected quickly, and many buyers who purchased at peak pricing suddenly found themselves in a shifting environment. Now, while the scale is different, the Federal Reserve has once again stepped back into purchasing mortgage-backed assets. The goal is to stabilize and stimulate lending, and historically, when liquidity enters the mortgage market, well, it tends to lower borrowing costs, which encourages more buyer activity. You see the cycle? But here's the part that often gets overlooked. Lower borrowing costs rarely increase housing supply, but they do increase competition. And this is where the conversation becomes very local and very important. The San Fernando Valley has been dealing with historically low housing inventory for years. Simply put, we don't have enough homes available to meet the demand. And when mortgage rates fall, buyers who had paused their search often jump back into the market at the same time. That creates more showings, more multiple offer situations, and more upward pressure on pricing. I've seen it happen repeatedly throughout my career. Buyers focus on chasing the lowest possible interest rate, but then the reality is home prices often react faster than mortgage rates fall. And when prices begin moving upward again, buyers can find themselves competing in a much more aggressive environment. So if there's one lesson that 33 years in this business has taught me, it's this. Trying to perfectly time interest rates is usually less important than timing affordability and inventory. If a buyer finds a home they love in a neighborhood that supports long-term value and a payment that fits comfortably within their budget, historically, buying sooner has often produced a better long-term outcome than waiting for the perfect rate environment. Because once buyer demand accelerates, inventory tightens, competition increases, and prices can rise very quickly. And when that happens, lower rates don't necessarily make homes more affordable. They simply allow buyers to borrow more, which often pushes prices higher. Over the long term, real estate has proven to be one of the most consistent wealth building tools available. Not because it never fluctuates, but because historically it trends upward over time. Organic growth, steady appreciation, and long-term ownership have allowed countless families to build generational wealth through home ownership. The challenge comes when the markets accelerate too quickly. Rapid spikes can create short-term speculation, and speculation introduces risk, which is why I always encourage buyers and sellers to focus on sustainable decision making, not emotional timing. So if you're waiting for mortgage rates to fall further before entering the housing market, you may want to also watch what happens to buyer demand and housing inventory, because history has shown us those two forces often move faster than interest rates. And if you're thinking about buying or selling here in the greater San Fernando Valley or surrounding communities, I'm always happy to help you evaluate your options based on current market conditions and long-term strategy. And if you wanted to better understand how to navigate selling a home successfully, I've written a free guide called Avoiding Failed Sale: How to Sell Smart and Walk Away Without Regret. You can download it at my website, mrchatsworth.com/ebook. If you found this video helpful, please consider liking, subscribing, and sharing it with someone who may be trying to decide whether now is the right time to enter the market. As always, I'll see you around the neighborhood.